Is October really the scariest month for investors, or is it just a myth that refuses to die? Today, we're unpacking why October's reputation for market crashes exists, what you should actually pay attention to, and, importantly, what you can safely ignore when it comes to your investments this month. Let's get right to it. Every year, as the leaves start to fall, headlines start popping up about the October effect, the idea that stock markets are more likely to crash in October than at any other time. But is there any real evidence behind this, or is Wall Street just leaning into spooky season? Here's what we know. October has seen some of the most infamous market crashes in history. Think back to 1929, the start of the Great Depression. That was Black Tuesday, October 29th, when the market collapsed. Fast forward to 1987, and we get Black Monday, another October crash that saw the Dow Jones drop an astonishing 22% in a single day. More recently, in October 2008, the financial crisis was in full swing, with markets whipsawing wildly. So yes, there's some historical precedent for turmoil in October. But here's the twist. Statistically, October isn't actually the worst month for markets. In fact, data from the S&P 500 going back more than a century shows that, on average, September tends to be the weakest month, not October. The so-called September effect actually has more data to back it up, with average returns in September historically negative. October, by contrast, has seen its share of big swings, both up and down, but on average, it's a pretty neutral or even slightly positive month for stocks. So why all the fuss about October? A lot of it comes down to what experts call recency bias. Market crashes are traumatic. When they happen, they stick in people's minds, especially if they happen around the same time of year. A couple of big October sell-offs get burned into the collective memory, and suddenly, every October, people start bracing for the worst. Let's bring some numbers into the conversation. If we look at the last 50 years, October has actually been a turning point for the market more often than a disaster. Historically, it's a month where markets end a correction and start to rebound, rather than a month that drags everything lower. Since 1950, the S&P 500 has posted positive returns in October about 60% of the time. Not exactly doomsday. Another angle to consider is that October is the start of Q4, the final quarter of the year. Companies start reporting earnings, and investors are looking ahead to holiday spending and year-end trends. That means there's a lot of information hitting the markets, and volatility can spike as investors process all this data. But volatility doesn't always mean losses. It just means bigger moves in both directions. Now let's talk about what you should actually pay attention to this October. First, keep your eye on the fundamentals. Company earnings, economic data, and central bank decisions. If inflation is cooling, if companies are beating earnings expectations, or if the Federal Reserve signals that it's done hiking interest rates, those are all positive signals that can outweigh seasonal worries. Second, don't get too caught up in scary headlines. Financial media loves drama, and market crash stories get clicks. But remember, the market is powered by millions of investors making decisions based on real economic data, not just by calendar dates or superstitions. That said, it's always smart to be prepared. If you're worried about volatility, check your portfolio's risk level. Are you spread out across different sectors and asset classes? Are you holding investments for the long term? Historically, investors who stick to a disciplined plan and avoid panicking during periods of volatility tend to come out ahead. Let's zoom out for a second. Even if there is a rough patch in October, it's important to keep perspective. Look at long-term returns. Since 1928, the S&P 500 has delivered average annual returns of about 10%. There have been crashes, corrections, and plenty of volatility, but over time, the market has continued to grow. Short-term swings, even big ones, usually look pretty small in the context of decades of growth. Still, October isn't totally free of risk. Geopolitical events, surprise economic data, or unexpected moves from the Federal Reserve can all create sudden shocks. But these are risks that exist year-round. The key is not to let seasonal anxiety push you into making emotional decisions with your investments. So what can you ignore this month? Ignore the noise and the scary stories about the October curse. Ignore predictions that claim to know exactly when the next crash will happen. Nobody has that crystal ball. And ignore any urge to overhaul your entire portfolio because of a date on the calendar. Instead, focus on what you can control. Keep your investment plan up to date. Review your goals and your risk tolerance. And remember that volatility is part and parcel of investing. Sometimes uncomfortable, but usually temporary. To wrap things up, October has a reputation for being a scary month on Wall Street, but the facts tell a more balanced story. Yes, big crashes have happened in October, but the month is just as likely to be the start of a rebound as it is to be a disaster. The best move? Stay informed, stay diversified, and don't let calendar-based fears dictate your investment strategy. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more no-nonsense takes on the markets. And here's something to think about. Maybe the real October effect isn't about crashes at all. It's about opportunities for investors who keep their cool when everyone else is feeling spooked. Thanks for watching, and see you next time.